In a new piece in the National Review, our next guest warns of the possibility of Federal Reserve staffers pushing a recession narrative in an election year that leads the central bank to cut interest rates when that's not the appropriate move. Joining us right now is former Council of Economic Advisors Chair Kevin Hassett. He's now the Brent R. Nicholas Distinguished Fellow in Economics at Stanford's Hoover Institution. And Kevin, first of all, thank you for being here. This is kind of a complicated thought, so let's try and walk through the process on this. You think, basically, the market is looking for rate cuts that shouldn't be coming this year. We've heard that from a lot of economists, but you're kind of playing through the ways that the market could be right. What do you think?
Right. I think that there are really two parts. The part one is that inflation really isn't under control. If you look at core CPI, it's hovering about 4. There's a long track record that wage growth, which the Atlanta Fed wage tracker has at 5%, is kind of a floor for inflation until wage growth starts to go down and unemployment goes up. And so inflation's not under control. And so you wouldn't normally expect to see the Fed cutting rates. But then also GDP growth has surprised me and a lot of observers on the upside. Right now, GDP Now says fourth quarter GDP is going to be about 2.5%. We just had kind of a blockbuster retail sales number. Michigan survey said consumers are getting more confident again. So there are all these strong signals about economic data, especially like initial claims below 200,000. And against that backdrop, the idea that the Fed would start cutting rates at all seems preposterous. And if you look at futures right now, they're expecting rate cuts at every meeting from May on. And so I think that what the markets are saying is, geez, the Fed's going to do something that's inconsistent with the economic data. And the only explanation I have for that is that they are worried that the Fed might juice up the economy ahead of the election. I mean,
some of the people that we hear buying into this narrative of all these rate cuts think that the economy is going to get weaker. Other people seem to be MMT, modern monetary theory folks who say, well, we've proven that there's no bad that comes from this, so we should go ahead and cut rates as far as we can to get the economy juiced as far as we can. I haven't heard too many people come up with this theory that it's going to be Democratic staffers at the Fed who are pushing a narrative that doesn't exist in terms of a recession.
Right. Well, the bottom line, though, is that inflation is not under control. The Fed's job is to get inflation under control. And if they cut rates with a kind of strong economy and high inflation, then we have to come up with a theory of what the heck are they thinking. Now, Becky, I'm sure data can turn. You and I have been talking, for 20 years, and there have been times when we've been really shocked by the jobs number that came out when I was up at the studio in New York. But the point is the odds of a big economic surprise between now and May are not 90%. But 90% is what the Fed funds futures are saying the odds of a cut in May are. And so I don't know where numbers that high with that much certainty for rate cuts could possibly come from, because the economy is uncertain, right? So maybe it's 50-50 it gets worse. I don't think it's that high.
The other theory that's been thrown out, Kevin, is just this idea that we're going to have problems that come up in the banking sector at some point because commercial real estate or some other big kind of bugaboo comes out and you run into real trouble, and that causes financial system concerns. I guess the other reason would be we've got this huge federal budget deficit that needs to be financed, and high rates hurt that and have that impact, too. So I've heard all of those kind of theories out there. But the Democratic staffers one, that's kind of new, especially when you look at somebody like Jared Bernstein, who is the CEA chair now, who's basically their big argument is trying to say the economy is really great because they want to convince voters that things are great and to reelect their candidate.
Right. And the fact is that I mentioned it in the National Review article that you cited, that 95% of political contributions by staffers at the Fed go to Democrats. And so I can say, though, that, as you know, and in my article, I say I don't think this is going to happen. I think the futures markets are going to be surprised that the rate cuts aren't going to come. But I trust Jay Powell. I had lunch with him once a month the whole time I was in the White House. And he's a very good person, an honorable person who wants to do the right thing. But all the staff guys that are giving forecasts to these people are contributing to Democrats. And I'm just wondering, what's my theory if they start cutting rates in May? What's my theory of what's going on? And anxiously, I'd be saying it looks like they've lost their independence. And that's where the word lost comes from in the title of my piece. I think that if the Fed does start cutting rates with data where they are right now, then the Fed has lost. The political independence of the Fed is lost.
OK, let me throw another theory out at you. And this is one people have brought up on the show. That is that they would start cutting rates now now rather than later because they don't want to look political later if they were to cut rates closer to the election when the economic conditions might warrant it more?
You know, I think that what the Fed needs to do, what do they say at every meeting? We're going to be data-driven. They need to be data-driven. And data-driven is not an election date that was set when George Washington was president, right? Data-driven is we look at the data and inflation is down below 2 and GDP growth is slowing. And
Kevin,
we're seeing...
if they did look at the data, let's say October, and there was the potential for an idea of a cut based on the data, and they went ahead with it, people would say they were political then, too. I mean, it just seems like it's a catch-22 for the Fed, no matter what they do.
You're right. And the Fed usually, as you get close to an election, just doesn't move. And so history is on your side with that argument. But the point is, again, like, what are the odds that the data really goes south? The odds have to be very high, like 80, 90% to start moving in May, given where everything else is.
Well, let me ask you this. If conditions remain where they are now for the next several months and the Fed does nothing, stands pat, and then all of a sudden you get into some sort of a economic downturn or even a fiscal or a financial system conditions warranting it, some concern around that, would you defend the Fed for cutting rates then?
Yeah, and I'll make a commitment with you right now. I'll come right on Squawk Box and say, hey, I've been looking at the data, and they're doing exactly the right thing. You know, I think that's what central bank independence is all about, is look at the data and do the right thing. Be an umpire at a ball game that's being checked by the computers. You know, that's what we want out of the Fed.